All right, I posted the agenda. Let me post it again. We're going to start with the Corporate Transparency Act, and then we are going to look at analyze some deals, and then we will talk about year-end bookkeeping strategies, and then we're going to talk about a contingency attorney and business attorney, and then an advanced tax planning webinar that Ryan has coming up. So let me share my screen again. Again, for those of you that are in the wealth building program, I am extending an invitation for you. Those of you in New York, I don't want to hear it. You can drive down and come for my party, okay? December 28th, offices will be closed. You can come down for the day and come hang out with us at in Bowie. Starts at 6 p.m. But we're also going to have a Zoom option in this day and age of remote work. Even a lot of my staff would not be able to come in person. So we are going to, my husband might actually even be in Nigeria then. So we are going to have a Zoom option for those who are not able to make it in person, but please save the date. And I look forward to seeing you. All right, so let's start the Corporate Transparency Act. I'm just going to go through it really quickly, and then we will continue just sharing what has been shared with us. This is supposed to start, this is supposed to start January of 2024. If you are a company in the United States, you are supposed to now report about all the beneficial owners or the people who ultimately own or control the company. So this whole forming in Nevada, Wyoming, Mars, Jupiter, all of that is going out the window because you are required to state who the beneficial owners of your entity are. And this is being done by FinCEN, Financial Crimes and Enforcement Network. Just knowing how critical this is. Let's look at, so.
Report to who? Are you getting, is that where you're going?
Yeah, can you guys see my screen?
Yeah.
Yes, it has to be reported on the FinCEN website. It's going to be reported to the Financial Crimes and Enforcement Network. So does your company have to report if you are a domestic reporting company, if you are a foreign reporting company? Those two companies have to report. If you're not created, if your entity does not exist with the Secretary of your state, or you like a nonprofit, credit unions, banks, public utilities, you don't have to report. But pretty much if you're a corporation, limited liability, S Corp, C Corp, whether you're formed in a foreign country or formed in the United States with the Secretary of State, you are required to report. Okay? Who is a beneficial owner? If your company, if that owner owns at least 25% ownership interest or exercises substantial control, that's the people that you need to be providing information for. Okay? An individual that exercises substantial control is if they're a senior officer, they have the authority to appoint or remove certain officers, they are an important decision maker, or the individual has a form of substantial control over the reporting company. Okay. Does your company have to report its company applicants? If it is created and registered after January 1st, you are required to report, and you're required to do it within 30 days. If you were created before, registered before, you're not required to report, but you are required to give that beneficial owner information. You have 1 year to get it done. So everybody is going to use 2024 to report, but then any new companies that are formed afterwards, you are required to report. Okay. And then what else? I just X'd out the things that, so this beneficial owner information, you're going to provide their name, date of birth, address, and some kind of identifying number, non-expired driver's license, U.S. passport issued by the state, and you must also provide an image of the document. All right. Okay, so this is important. The initial report, existing companies, you have up to January 1st of 2025. So it's like a one-time filing. And then new companies, you have to do that within 30 calendar days. And the penalty is $500 per day that you do not report. They are talking about possibly giving a 60-day extension after the 30 days, but that's not yet finalized. All right. Okay. If you have any updates to the ownership information, you're supposed to report that within 30 calendar days, including a driver's license. So if you update your driver's license for the beneficial owner, that's considered a change that needs to be reported with FinCEN. Okay. I think that's pretty much it. They say they're going to come up with additional guidance, but I just wanted you to be aware of this. I'm going to go ahead and post the link that you guys can look at to get more information. I will take a couple of questions before we move on, maybe just about one or two questions.
Hi, this is Wayne.
Yes, hi, Wayne.
Hi, you said the percentage of the company, the person for the secondary, if you have a dual person owning the company, they have to have more than 25%?
Yes, at least they have at least 25%.
Okay.
Yes.
And and you also mentioned if they have controlling entity, when I say controlling entity, they may not have 25%, but they have a voice in the way the company is run. You still have to report them, correct?
Exactly. Yes.
Okay. All right.
All right. And Lori's question is, my self-directed IRA, who reports, you or the administrator? It would be the administrator because they're the trustees, and they're the ones that are responsible for this. However, if they don't report, you do need to make sure that they report. I know a lot of lines are even blurred. Like, for example, are we even allowed as CPAs to file this on you guys' behalf? There's still an argument there about unauthorized practice of law. So that's still up in the air in terms of who should be reported, what should be reported, and all that. Will this information be public facing? Yes. It's actually on there. I just sent you the link. You can go to the link, it's on there, but it really has not been finalized. Okay. What about if it's owned by another entity? You're still gonna remember, that's why they said that you control somebody that has that reported entity. Let me look for it. So that means that the owners of the entity that owns that entity are the ones, it says exercise substantial control over a reporting entity. And then let me get it. The individual has any other form of substantial control. Any other form means that you control a reporting entity that controls another reporting entity. So in that case, yes, you would still need to report both. Okay. All right, so we have our guru here today, Mr. Joy. Thank you for coming on. I like to bother Nate. Every week I'm sending Nate stuff and Nate is saying no, and Nate is getting on my nerves. So I told him, can you come on today and tell me why you keep telling me no? Because we were told drive for dollars. Oh, whenever you drive through a neighborhood and you see a really good property, take a screenshot of it and send it to Nate, and maybe he might give me some little change. But every time I do that, Nate is like, no, that doesn't qualify. So I'm like, Nate, what does qualify? And I said, oh, you know what? We actually have a meeting coming up. Can you please come on? Because I want people to see how I interact with you, ask you questions, and how you redirect. So let me show you guys what I sent Nate yesterday. This was coming back with my son, the one I told you about. He went for his driver's license yesterday. By the way, he was not listening to me. They said you need a Social Security card because the W-2 has redacted socials. Little boy was not listening. He thought mommy doesn't know what she's talking about. And sure enough, we got there and they sent us back. But anyway, on our way back, we saw this property near MVA. And I immediately took a picture and sent it to Nate. And Nate goes like, Barry, just looking off the top. This is not a good deal. I'm like, okay, Nate, please come on and tell us why you think this is not a good deal. And then what do you consider a good deal in this market for, people to do deal? Like, how do you analyze your own deals as well? So talk to me, Nate. What am I doing wrong?
Hey, Bear. So, I mean, most of the times the issue is right here. It says 450 as is, you pay all closing costs. So right off the bat, you're gonna be probably into the property before you even swing a hammer for like $470,000 minimum. And then it says sell for $550,000. I mean, number one is you're going to need renovations, which will probably, it's not too many houses that you're going to be able to renovate, fairly cheap in this market. So that's like the spread is just like way, way too tight. $100,000 sounds pretty impressive, but once you add in closing costs and everything else, it really, gets eaten up pretty quick. Does anybody else on this call have a potential deal that they would like us to run? Because sometimes it's better, when people have like you, where we could actually, kind of go through it. If not, I can go over a deal that I just closed on and bought, last week. But like I said, you might get more benefit out of it if it's one of your deals. So,
well, let me ask you a question before we open. Please, if you have a deal, post in the chat. So let me ask you my personal question.
Okay.
I thought that anytime I see anything like this, where there's a property for sale or whatever, I automatically screenshot it and send it to you. What I was expecting was, instead of saying, hey, Barry, this is not a good rehab deal, I thought you would tell me this is what you should offer. And if they accept it, then maybe it's a good deal. So why did you off the top not even want to look at it versus this is how much we need to do it at in order for it to work, and then just submit an offer based on that?
Yeah, I mean, we can do that and do an offer. I was just off of the top, just showing you with the sign that the numbers weren't going to work, but without even having an address or anything. But yeah, I mean, if you send an address, I mean, and typically I run every deal and I will give you a number that would work, but I know that it's not going to be anywhere near the number, on there. And what I'll do is I'll show you how we actually run the deals. And so, we can put it in the calculator and you can always, kind of figure out, your own. And this calculator will help some of your other clients as they're running their deals. So,
okay, because of time, we can go ahead and look at one of your deals. Since you closed last week, like let us know what you did. And for those of you that are asking, Nate is a client. He is in the wealth building program, and he also has a lot of rental properties and does rehab. Just recently retired to focus on real estate full time. So he's the one that I'm always bothering whenever I have deals to look at.
Okay. So, is everybody able to see? Because I'm like bad with this, but are people able to see the screen?
I can see it.
It says a hard money. Does it say hard money calculator?
Yes.
Yes.
Okay, perfect. All right. So basically, you know, and I know there are plenty other investors on here. So, you know, my disclosure is that I don't think this is like the only way or the best way to evaluate a deal, but this is the way that I do it. So I'm like open to other people's opinions. But there was a house, basically, the address was 6512 North Capitol Street. The purchase price so this, first of all, this calculator, everybody can go to it. If you Google hard money loan calculator, there's right up here, it's new silver. It's pretty, there's a lot of other calculators out there, but I find this one to be very easy and I like it. So that's where we are right now. So basically the purchase price was $285,000. The rehab budget, and so just so you know, I already pre-filled in these numbers, but basically the calculator will come like with a standard, let me see if I refresh it just so we could do it from scratch. All right, so this is how the calculator will come. It'll already have stuff in here. And then you're gonna just change and put in your numbers accordingly. So my purchase price is $285,000. My rehab budget just so happens is $100,000. The after repair value is $579,000. Most of the real estate investors on here already know how we're getting the after repair value, but just for those that might not, we basically take the comps within the last, we're doing like 30 to 60 days. It used to be you run comps for like 6 months, 3 to 6 months, but the market is so dynamic now that we're only looking at stuff within the last 30 to 60 days. So there's an exact comp, like a block over, that just went under contract for $579. I talked to the investor who did it, so I feel pretty comfortable with that. So we just went with $579. The property taxes are probably around $4,000. Loan to project costs. I'm writing this up as though hard money. Everybody's numbers will be different. I know there's some lenders on the line, so you'll just talk to your lenders and figure out. My loan to project cost is typically 90%. They'll loan me up to 90% of the total cost of the project. Turnaround time, this is a DC property, so the average rehab usually takes about 2 to 3 months. It probably takes about, on average for us, about 2 months to get permits, and that's with the drawings and the permits. If people are getting them quicker, I would love to talk to you to see how we could expedite that. But right now, our permits are running about 2 to 3 months. It usually takes, because the market is slowing down a little bit, and it's always better to be conservative, I would make the turnaround time more like 10 months. So 2 to 3 months to get your permits, 2 to 3 months to actually fix up the house. So you should be all in around 6-month mark. And then that gives you 4 months, you know, potentially to find a buyer and a deal. The interest rates now for hard money, I'll put it at 12%. We actually get it a little lower. Our origination fee is like 1%. The last deal that I did with hard money, you know, I probably could have got for 1.10.5%, but I'm doing this more for what other people might be seeing in the market. The closing costs are 0.5%. Now, this could change because typically with investment properties on this calculator, you would want to, if you're paying both sides of the transfer and recordation, you're going to want to double this number down here. So instead of 1.5, it'll probably be 3%. we were actually direct with the agent and the owner. So our closing costs were, pretty standard, around 0.5%. And the recordation is around 1.5. Realtor fee, that's 5%. That's on the relist. Typically, for all you real estate agents that are on the call, we tend to give whoever brings us the deal, we tend to give it back to them. And so we give 2.5 for the buyer's agent, 2.5 for the listing agent. If we find the deal ourselves, we will typically, if we find the deal ourselves, we'll typically do 4%. So we'll do a 2.5, and that could even go down to 3.5 because we'll list it with a fee for service type of broker. So that would cut it. But on this one, we'll just do a traditional relist with the agent. And that's like, I'm sorry, trying to get the cursor to move, but here we go, 5%. Holding costs monthly, that's basically just your utilities and stuff. It doesn't include your actual mortgage payment, but you'll see that towards the end. I'm not sure why this, I don't know how to, oh, hold on, there it is. I'm trying to get rid of this little bar that's showing there. All right, so when you hit the calculator, this is what will come up. So it'll show you what your net profit is. So for paying $579, purchase price $285, $100,000 for all of these variables, your interest rate being 12% over a 10-month period, this is what you would look to probably make off of the deal. You'd probably make about $111,000. Your total interest cost will be about $34,000. So over a 10-month period, you'll be paying like about $3,465 per month. And then it breaks down everything. So the purchase and rehab at $385, we're doing 90%. You'll be all in with all your fees and everything for $467,000. And then it just kind of breaks down how they get to this $467,000. But here's the final kicker that I like. Even though the whole project is costing us $467,000, you're really only investing of your own money about $38,000, and then you got to pay the interest every month. So you're really spending about, what is that, $72,000. Your draws of this 100,000, you just got to put the money up like 10 or 20 grand first, and then your money comes back to you in terms of draws. But if I know it says the return on investment is only 23%, but if you really look at cash on cash, you're only spending $38,000 plus the interest, which is 72, and then you add about another 10 or 20 grand for your first draw, which you get back. You're about $90,000 out of pocket just for the transaction. So you're really, this return on investment, you get your full 90 back and you make 100. So it's like really 100% return. And that's pretty much, how we look at, the deals. And like I said, this calculator, anybody can do it, and it's pretty simple. So does anybody have any questions or comments, or they do it differently?
Okay, let me ask a couple of questions, and then we have to move quickly because
Okay.
we're running behind. Nate, you're not a realtor. I do your taxes. You're not a realtor, but who do you use as a realtor?
Well, like I said, whoever brings us the deal, we usually give it back to them to relist. But if we relist in-house, I have an in-house realtor that will relist it for like a fee for service. And there's plenty of fee for service listing, like Mr. Lister, different places like that, where you could just list it for a flat fee.
Mm-hmm. Is it okay to buy land downtown? The permit is to be pulled. How much will a 2-story cost to build? Is this a go or not a great investment?
I'm sorry. So,
You can stop sharing your screen.
okay. How do you do that? Okay, stop share. Okay, perfect. And what was the question? Land?
Is it okay to buy land downtown? The permit is to be pulled. How much will a 2-story cost to build? Is this a go or no go investment?
What is that meaning? The permits, they gotta buy the land and then they gotta actually get their permits?
Yeah, it's yet to be pulled. Yeah.
Yeah, so I mean, basically, without knowing any of the details, I mean, the average building price is probably about $225 to $250 a square foot. So you would add the land plus, if you're saying 2 stories, say it's 2,000, 2,000 square feet, you're going to probably be somewhere just to actually the physical cost of building is probably going to be somewhere around $250 a square foot. So you just have to calculate those numbers and then figure out what you could resell it for or rent it, and then, decide whether, it makes sense. They could put it in the calculator if they want.
Okay. All right. Well, thank you.
You're welcome. Any
Please
other
post-
questions,
you
if
have
people
a
want to
yeah,
email
you
me?
have do you have a website for your program that you want to post while we move on?
No, I'll put my cell number in the chat, and then if
Okay.
anybody wants to get in touch with me, even if they, have a question, anything I can do to help them, they can text me, and we'll make it happen.
All right. Thank you.
All right.
Nate. I am
Sounds good.
about to bring on Martisha and Alima. They're going to be talking to us about year-end tax planning from a bookkeeping perspective and the things that we all need to do to get ready. So thank you, Martisha and Alima, for joining us. These are my bookkeepers. They're the ones that help. I don't like dealing with bookkeeping. They do all of that. So you guys, welcome. Can you guys just share with us some tips that we need to keep in mind? And then we can take questions and close out. Thank you, guys. You need to unmute yourself, Martisha. There you go.
All right, perfect. I think I'm unmuted. All right. Thanks, Sabera, for the introduction. I've had the pleasure of working with many of you, and those who I have not had the pleasure with, I look forward to working with you soon. I am a CPA here with the Wealth Building, and we also have Alima, and she's a tax preparer and also a bookkeeper here as well. So the focus of today, and if you see me looking different, it's because my camera's in a different place, so just don't mind that. All right, so we want to focus on the year-end bookkeeping strategies that you all should be focused on, especially if you're taking advantage of our year-end tax planning right now. And so this is just a checklist that we put together, and we're going to go into more detail on the things that you can be doing just to make sure that you're in a good place for year-end, for tax preparation next year, but also year-end tax planning if you are taking advantage of that. All right, Alima, I'll let you go ahead and start.
All right, good afternoon, everyone. So to start off with, we want to, the first thing you want to do is you want to have your business receipts organized. I know, throughout the year it can get kind of hectic, but what I've told a few clients, I may have told someone on this call, but if you take just 5 minutes when you purchase something and they print out the receipt for you, either take a picture of it and send it to like a Google folder and kind of organize it by month. And that way you always know where it is. Or if you're using QuickBooks online, you can email the receipts straight into QuickBooks. And then the receipt sits there, and then it allows you to be able to attach it to an expense or an invoice at a later date. But at least you have that documentation that you'll need in the case of an audit effort. And then you also want to work on doing a cash sweep. Sometimes, I know not all the time, but sometimes you use your personal accounts for business expenses. And while it's not ideal, if you do use it, you do want to be able to get the deduction for it on your taxes. So you want to be able to go through your tax return, your bank statements, and just kind of track which expenses were business expenses. So you can input that information into your tax software, or you can provide it to the tax preparer when they're working on your taxes. Next, we have the expense categorization. Just making sure the categorization allows you to be able to provide an itemized statement showing the totals for your business expenses. Again, you won't want to miss out on an expense because you forgot to categorize it, because you forgot the receipt, because you can't remember that you spent that money, or if you spent this year or last year. And then the last thing, you also want to look at reviewing your past due invoices. If you are a person who invoices clients, you want to take note of those past due invoices, the invoices that have not been paid as of, let's just say, November 28th. You want to keep note of those invoices. So when we are doing your tax planning, we can determine whether or not you need to go out and try to collect those funds, or if you want to hold it off until next year to kind of add some income for next year. All right, Marticia's going to talk about the reconciliations and financial statements.
All right, perfect. I did just want to add one more thing to Alima's suggestion of completing a cash sweep, especially if you're a new business and, we've just set up your LLC. Because the LLC is already set up and you don't have, because the LLC was not set up and you don't already have the business bank account, then 100% of the time you would have paid for that setup fee and also, the LLC state fee out of your bank account and just even your startup costs. So you do want to make sure that you're looking back through your personal bank accounts just to make sure that you've picked up everything. For tax preparation wise. We don't want you to overpay just because, you didn't have adequate bookkeeping. And also, now is the time to go ahead and reimburse yourself from the business for that expense, especially depending on what type of business that you have. So a lot of our business owners that may, be considered a flipper, you might be set up as an S corporation. In that case, you need to go ahead and reimburse yourself at a reasonable time. So now would be the time to reimburse yourself rather than waiting till next year or us doing it on the tax return. All right, so the main things that I want to focus on is going to be reviewing of the financial statements and also your account reconciliations. The number one thing that's important in bookkeeping is going to be those account reconciliations. It's going to catch where either human error falls short, or also where your accounting software falls short. Maybe the bank got disconnected, you're using QuickBooks, you're using Wave, you're using Buildium, and your bank got disconnected and you actually didn't even notice it. And so if you do the account reconciliations, it'll help you determine when either you're understating your expenses, which that means you're paying more to the IRS, or you're overstating your expenses and we don't want you to get flagged for an audit. And then same thing with revenue, either you're overstating your revenue when you're going to pay more in, or you're understating it. The credit card, that's also a huge thing. So you get the deduction for an expense when you swipe the credit card, not when you pay the credit card bill, because you've already incurred the liability. So you do want to make sure that you're picking up your credit card in your bookkeeping as well. Same thing for the loan accounts. Now with, a lot of us being real estate investors, with the loan accounts, we are going to pick up the mortgage interest, property taxes, insurance from your mortgage 1098 statement. So we have you covered there. But sometimes when you're using like hard money loans and private lender and stuff, you're not remembering to pick up the interest. And if you have a mortgage, it may not stand. If you have a separate mortgage, it may not stand out to us that you're missing mortgage interest. So you do just want to make sure that your due diligence is being done in your bookkeeping. And then for those of us that have payroll, it's also the perfect time to make sure that your payroll is reconciled. So usually we focus on reconciling the balance sheet accounts, but we also want to make sure that we're focused on reconciling some of the profit and loss statement accounts, main one being payroll. So with payroll, ideally, you know, when we do your taxes, we do ask for the payroll report. But outside of that, you know, bookkeeping should start in-house. And so with the payroll, if for whatever reason your payroll was picked up incorrectly and, you know, it got reported on the tax return, you definitely will get a letter from the IRS. You'll get a letter from Social Security saying, hey, those tax returns you filed, they do not tie into what was reported to Social Security. So now that's just adding unnecessary work. It's a waste of your time when you can just go ahead and reconcile your payroll. And then again, you want to make sure that you're not understating it because, you know, now you've already paid all of this payroll to your staff. If you're an S Corp, you paid yourself, but then you've paid in the, your taxes. So you've paid Medicare, Social Security, you paid the FICA, but you didn't even get the tax deduction for it because you didn't reconcile your payroll. All right. And then the other thing is to review your financial statements. And what I like to do is I like to do a balance sheet and a P&L analysis, a profit and loss statement analysis. And that's where I'll just run like the profit and loss statement. You can just compare last year to this year. So compare 2022 to 2023. And that allows you to see if you're missing anything. You'll be surprised if you're missing income, you know, because you had such a great year. You're like, when you get to taxes, we're like, oh, your income has decreased. And you're like, you know, it decreased. I thought I was doing really good this year. And then you see someone didn't pay you an invoice. Or maybe your expenses look understated and it could be possibly that something was missing, you forgot to pay something. A lot of times we don't necessarily forget to pay stuff, but we do forget to ensure that our bookkeeping is updated so that we're getting the tax deduction for it. So just doing a comparison from last year to this year, just to make sure that everything is accounted for. And then the next thing is going to be just doing a balance sheet analysis. And the balance sheet is just kind of looking at, so your balance sheet shows you, and I actually have a balance sheet here. I'll come back to the chart of accounts, Alima. But, you know, just taking a look at your balance sheet. So when I look at my balance sheet as of November the 28th, you know, on November the 28th, or this one is October 31st. So on October the 31st, did I actually have $4,147 in my bank account? If I did, okay, my account looks good. And you do have to account for timing differences. But for the most part, that balance that's shown on your balance sheet should actually match what you had in the bank. If not, it's an indicator that you need to take a look at your bookkeeping. And, you know, we don't want to get to a point where we try to do our due diligence when we're preparing your tax returns to say, hey, I think you're missing something. This doesn't look right. And then, you know, sometimes everything just looks great. And we don't ever want to get to an audit and it's like, oh, I didn't even realize that that was incorrect. So now you're having to pay additional taxes because, you know, your bookkeeping wasn't dug into. So that's just something to go ahead and do your due diligence, take a look at it. And also, you know, we do offer that service, so we can definitely look at it as well. I'm going to go more on the balance sheet, but I'll let Alima explain the chart of accounts more. So let me just back out of this. All right, perfect. There you go.
The chart of accounts is the breakdown of how, as you can see, how your balance sheet and profit and loss will look once you've started categorizing expenses or transactions to those accounts. So once she flips back to that balance sheet, you'll see the way for rental properties. If you have the property, you'll have the property listed out as a building. The land amount will be separate. And if this is a property that you had on a tax return for a prior year, the land amount would show on your depreciation schedule. And then you have any type of property improvements. These are not monthly expenses. So like utilities will not be coded to property improvements. These are things where if you had to redo a roof, if you had to gut a whole building and then repair everything, those will be your improvements. Any type of loan fees that you pay when you purchase the property, so when you break it out on your chart of accounts like this, once you look at the balance sheet, then it will kind of give you a better idea of where each property is. You can go ahead into the next one.
All right, perfect. Yes. All right. So especially in real estate, a lot of times that we're shelling out money. And then when we get to do your tax returns, it's like, oh, I spent so much money. I don't really understand where it went. I don't see the loss on my tax returns. And so that's going to be noticed, knowing the difference between it being a profit and loss item. So it being considered, like an expense on your tax return or a tax deduction versus it being a capital improvement. So when you purchase a rental property and you make all of these major repairs and capital improvements, and you replace the roof and all of that stuff, you're not going to get a dollar for dollar tax deduction now in 2023. It's going to be spread over years, and specifically for a rental property, it's going to be spread over 27.5 years. So that's just things to notate when you're doing your bookkeeping. So this is how a balance sheet would look. This is how a balance sheet would look for, let's say we had a rental property. We would actually have the building costs. 1 second. Yep. So we would have the building costs. We also would have the land costs, and we'll have the depreciation. And that's kind of how your balance sheet would look. So if you didn't finance that property and you pay for it all cash, you're not going to get the full $43,000 deduction that you paid for it. Well, actually, you would have paid $63,000. You're not going to get the full $63,000 that you paid for, because a portion of it, well, it's going to be capitalized, and then it's going to be split over 27.5 years. All right. And so that also helps you to tax plan, because if you have W-2 income and you're also real estate and you're also investing, you might think that, okay, my W-2 income was $120,000, but I paid $63,000 in purchasing my rental property, rehabbing my rental property. That $63,000 is not going to offset your W-2 income. And then, also we have to take into consideration, if your W-2 income is over $150,000, you may be subject to like passive activity limitations, but we'll save that for another day. We'll focus on bookkeeping. All right. And so this is going to be an example of a profit and loss statement if you have rental properties. So if you have rental properties, you need to be tracking your books by class, by property. So when we do the tax returns, we're able to see it. We need to be able to see your financials by property, and that's how we're actually going to report them on the tax return. So if you'll have rental income for each property. Here we have Spence Avenue and we have L Street. And then this is especially important for clients whose income is over 150,000. So maybe your rental losses are subject to passive activity loss limitations. In that case, you want to make sure that you're splitting out your general business expenses. So your general business expenses, in this case with the rental property, advertising and marketing, if it's tied directly to the properties, that won't actually be general. But let's say, for example, your bank charges and fees, if you had any education expenses, your accounting fees, all of that stuff you're going to be able to get a tax deduction for it. And also it will be able to offset your W-2 income if your income is, limited based on the passive activity loss. So that's another reason why it's important to make sure that you have your bookkeeping set up with class tracking. That way you can see the different properties and also the general expense, which is not going to be limited. All right. This is going to be specifically for those of us that, rehab property. So whenever you're rehabbing the property, that's going to be a balance sheet item too. So you're rehabbing the property, but you're planning on selling it, not renting it. So we just have that set up on the balance sheet as like inventory costs. And I'm just keeping track of the time because we're running short, but we're almost done. Just bear with us. So I'll just show you this really quick. So yeah, while you're rehabbing the property, all of that stuff is going to be sitting on your balance sheet as an asset. And these are going to be like your holding costs and stuff like that. And then when you actually sell the property is when you'll be able to take a deduction for all of those costs that you put into it. All right. And so this is just an example of, we had Carousel Street. We had it sitting on the balance sheet while it was being we had it sitting on the balance sheet while it was being rehabbed. And then once the property sold, you can see that this is the revenue that it sold for, and this is all the holding costs. So they invested $313,000 in it. All right. And then the same thing. So even though, you know, if you're taking 2 years to rehab a property, you're not going to reap the benefit of all of those expenses until after the property has sold. But again, you still get to take advantage of your general business expenses. So you're still paying fees to your accountant, you're still paying your bank fees, insurance only if it's not related to the property, it's just general business. All right. And then this is just a listing of our service, which we can send it over to anyone if, because I don't want to take too much time. I want to leave room for questions. But we do have monthly full service bookkeeping. And also, you know, we have quarterly reviews. So we will review your bookkeeping and then just provide you like a list of review points. And then sometimes it's not even that bad. It's like, hey, can you just complete the quick cleanup for me? Yes, we'll go ahead and do that for you. And right now with year-end tax planning, so these are more so, you know, to put yourself in a better place for the future. But while we're in year-end and we're focused on 2023, we do have also where we'll just do a diagnostic review and provide you with like a either you can fix, you know, based on the points that we gave you, or we'll provide you a quote to give you a quick cleanup so that you can take advantage of year-end tax planning. And this is just our training services, which clients use a lot throughout the year. And that's it, since we're tight on time. All right. Abera, do we have time for questions? I see you were answering most of them in the chat. Thank you. I appreciate that.
Thank you, thank you, thank you. If you guys can give us about 10 or 15 more minutes, but if you have to go, we understand. So what I want to do is to answer some questions. I'm not sure if the Ferrari twins are on, and then I have a couple of announcements, and then we're done. So I am going to talk about some of these questions and then take it from there. So somebody asked if we have experience with franchise bookkeeping and tax returns, and my answer was yes. We do have clients who are in a franchise. Brendan wanted us to define a business, and I think he's asking that because he has a rental property. And so my response was that yes, having a rental property, you are a landlord, you are in the rental business, even your income is going to be considered passive income. It is still a business when it comes to bookkeeping, keeping your books straight, keeping it not commingling and having everything separate, having a balance sheet and an income statement. Okay, and then KO wanted to know whether or not an LLC holder can reimburse itself. Yes, when you incur expenses under your personal credit card, although we discourage that, you can absolutely reimburse yourself, and that's what we're talking about, the cash sweep. Melinda wanted to know, can you do a cash sweep for 2022 transactions that weren't accounted for in 2022 taxes? And we said yes, it would just be a matter of doing like an accounting change method, filing a form 3115. So that's something we'll have to review the types of expenses and see how an adjustment can be made. Okay, this one I want you guys to respond. What's the best accounting software to use that's not complicated? I said QuickBooks, but then there's Xero and Neat Receipts. Do you guys have any others?
That's a good one, but they're all kind of complicated. But Wave Apps is another, and it's free. So I know that's a big thing. It's free.
Okay, can you post that on the chat so that those who don't know? Another thing that's really cheap and not complicated is Excel spreadsheet. We do have a sample business workbook. If you want to use a workbook, we can provide that. If you want to track it yourself on a monthly basis, it tends to get cumbersome, but you can absolutely do that if you want. And the question, somebody wanted to know if a tax liability can be discharged in a bankruptcy. Then the answer is yes. Whatever cancellation of debt income you have, whether it's a bankruptcy or whether it's a short sale on a property or somebody forgave, credit card cancellations, you will have cancellation of debt income. However, you can file an exclusion based on insolvency, meaning that your assets were less than your liability at the time that the debt was forgiven. If you're able to show that, then you're able to exclude the cancellation of debt. Okay, and Wayne wants to know if we're gonna get copies of the sample sheet. So I think it's the same one that Alima had from before. So if you guys provide that, we will include it when we send out the recap. Okay, and Brandon wanted to know income that is overall, is the $150,000 limit for claiming passive activity losses, is that just for the business or overall? And the answer is overall based on AGI. So if your AGI is over $150,000, you are not able to claim your passive rental losses unless you're a real estate professional. Real estate professional meaning that you spend more time in real estate than in any other active profession, and that is at least 750 hours a year. That's about 14 hours a week that you need to be spending. Okay. Okay. Somebody said they use Tessa. Somebody uses Wave. Somebody wants to know if we work with a nonprofit. Yes. Is the insolvency cancellation of debt statement true for PPE loans? Yes. Any kind of debt that is canceled, as long as it is canceled, that's something that you would have the cancellation of debt. But again, if you can establish insolvency, you are able to get that waived. Okay. Let's see additional questions. Okay, the twins are here. So let me have you guys come up. I'm going to post some links in the chat. One link is our year-end tax planning tips. Feel free to read that. You would be able, for those of you that are not going to have the time to do the year-end tax planning, you can at least read these tips to be able to get some things that you need to do before December 31st. So let me post that link right now. And then the next link that I'm posting, for those of you that have where your tax liability is at least $75,000 or more. If your tax liability is at least $75,000 or more, you can consider signing up for Ryan Foncannon's High Tax Impact Strategies for High Wage Earners. That's coming up this Thursday at 5 p.m. PST time. So I'm also sending that. Okay, Ferrari sisters, do you guys want to come on? And I know you guys have a deal you want to talk about. Tell us a little bit about it, and we'll keep answering questions until 4:15. Thank you, Martisha, and thank you.
Awesome. Thank you so much for giving me the opportunity. Hello, everyone. I will be brief since I am still at work, a W-2. So here I am. My reason for being here and announcing this project, it is an amazing deal that we have on the table, so to speak. We currently, my sister and I, we currently invest in mortgage notes. And we are in the process of having a deal right now that is offering about 12.75. We always under-deliver so that we can over-deliver. So this is where we are now. This is in Oklahoma. We get the tape first. If anyone knows anything about mortgage notes, it is true passive income. When I say passive income, it is true. You literally, money comes to you and you don't do anything. And we are JVing with a couple of people in this deal. The seller is selling on a discount. The properties that she has, it's worth over $5 million, what she's providing to us. There are others in the deal. Yes, I will post that. Yes, I will post this out there. So we, and Natasha's correcting me. I think I said this wrong. Thanks, Nat. That's my sister. She's always there to correct me. Appreciate you. Basically, we are looking for investors to invest with us. We will post the information in here. Basically, the deal is a mortgage note where we have a very motivated seller who wants to sell the land that she has. She built this business with her husband. Her husband unfortunately passed away. It's very sad. And she no longer desired to hold on to those notes, and she wants to sell them on a discount. And we have this deal right now. and we don't want to pass this out. So anyone who's interested would like to know more about this passive income opportunity, I will put my information in here in the right there. I believe Natasha is doing so as I speak. Please reach out to us so we could speak more, because I know a lot of people are either at work or have other things to do. So therefore, please take a moment to look at the information we'll put here. And I know that Iberi will also do a blast regarding this opportunity. It's happening. Our intention is to close in December. We already studying the papers, working with attorneys on securing those deals. So please reach out to us so we could discuss more. And I thank you for your time.
Thank you, thank you, thank you. So if you're interested in getting into the note business, please go ahead. I'm also going to send a blast, or send me an email and I will put you in touch with them. Okay, any additional questions, tax related questions, general? This is our last webinar for the year. Okay, it looks like a lot of people are interested. Please start writing down their names. Melinda is interested, Veronica is interested, Nathaniel is interested, Nikki's okay, everybody is interested. So I will do it as a blast to, first of all those that are attended the webinar so they get it, but also to the list as well. Okay.
Okay, thank you so much.
Yes. Anybody have any general last minute questions as we get ready to round up?
Yes, this is Gary.
Mhm.
I wanted to ask you, right now we're in the process of putting stuff in our family trust. Is there anything from a tax perspective we should be thinking of for putting single families into the trust? Does that affect the taxes in any way?
It depends on how the trust is registered. That's what I usually tell people. The most important thing is, how is the trust registered? If the trust is registered as a complex trust, then you will end up losing the tax benefits, because it means that whatever income and expenses that belongs in the trust is taxed at the trust level, which is at about a 35% tax rate. However, if it's a simple disregarded trust, meaning that all of the income and expenses is required to be distributed every year to the beneficiaries, then there's no difference. Even if you have it in the trust, you're still able to pick it up on your individual tax return. Okay.
Answered.
All right.
And this event, Iberi, this event is in this. I'm trying to open this wider. Oh, this is in Maryland.
Yeah, it's going to be in Maryland. So I need y'all coming up to Maryland, my New York folks.
I may need to come in December 28th. Count me in.
Yes.
That sounds awesome. I want to come. I want more information.
Yeah, we'll definitely be sending it out. I need my New York folks here. I need my California folks here, Florida, everybody. I need you guys out here so we can celebrate, okay?
Yes.
All right. How do you recommend we register a trust? The best way to register a trust is to, first of all, form the trust document. So you have to, first of all, execute the trust document. Then you can get an EIN for the trust. It does not have to be registered with the Secretary of State or an SDAT. As long as you execute the trust document and get an EIN, those are the two documents that you need to effect the trust. In some instances, depending, like if it's a solo K trust or trust that's tied to a retirement account, you now need to have that registered with the IRS separately. But that's, that's a very different arrangement. So to register a trust, you don't necessarily need to register it with SDAT, Secretary of State. You just need to execute the trust agreement and to get an EIN for the trust. Okay. Any other questions as we start rounding up? Okay, let me just go through one or two tax tips since I said 4:15. Let me share my screen. I'd already shared this link. I'm gonna share this again, but I wanted to share some tax tips. If your employer can defer your bonus into January, so instead of getting a year-end bonus the last week of the year, they can hold it for the first week of the year and you defer that income. right? You may want to consider not selling a stock with a gain until January to defer the recognition. Likewise, sell a stock with losses before year end. Just note that only $3,000 of the losses can be deducted. Charge deductible expenses on your credit card to get a current deduction, even if the payment of the charge will not be made until the next year. This is a very important strategy that you're able to utilize, especially if you have expenses that you're going to incur from January through March. You can incur those expenses in December on a credit card and be able to claim it as long as it's ordinary and necessary. Make charitable donations with appreciated stock owned for more than 1 year. The fair market value is used to measure the donation, and there's no tax on the difference between your cost and the fair market value. Okay, make the maximum contribution to retirement arrangements, whether employer-sponsored or IRA. Consider an instrumental sale of property rather than collecting all the proceeds this year. You can defer part of the gain on sale until you collect the cash. Let me actually talk about this last point, and I'll take additional questions. When you are selling a property and you're not going to collect all the money up front, you do not want to do it as a, what do you call it, like as a seller financing, where you take back a note. You're better off doing it as an installmental sale, because when you take back financing, you are going to pay capital gains on that income, whether or not you've received it. So that you got back a note is irrelevant. The bottom line is that you've sold the property and you are going to have capital gains. But if you did it as an installmental sale, that means you pay taxes as the buyer pays you. You only pay capital gains just on the portion that you receive for the year. Okay, so that's the difference between selling through installmental sale versus doing a seller carryback. Okay, how does that relate to a revocable trust? Same thing. The same thing with the revocable trust is depending on what you told the IRS, because the IRS is going to ask you, are you going to be distributing income every year currently? If the answer is no, then it's a complex trust. You pay taxes. If the answer is yes, then the beneficiary pays the taxes. Okay? I have a trust that was created in 2023. I need to add this. Okay, please make sure you send us an email letting us know about the trust. Okay? I only have one rental property, planning to put into an LLC. It depends on where the property is located. Each county has their own rules. Some county will require you to pay a transfer tax in order to move the property from your name into your LLC name. And then also keep in mind, if you're ever doing any kind of financing, then if you're doing any kind of financing, then that means that the lender may not agree to refinance in an LLC if it's a residential property, or sometimes if they do agree, the percentage point is higher. So make sure that you are talking to your lender to know what they can and cannot allow before you put the property in an LLC. And outside of that, very good umbrella policy, using a property management company, even if it's your own property management company, is better. Okay. Can you explain selling the stock at a loss and donating to charity? Okay, two separate things, Nate. Selling a stock at a loss gets you the $3,000 deduction for the year, but you can donate appreciated stock to charity and get a deduction for the fair market value, not what you bought it at. So if you bought a stock at $2,000, but then you donated to a charity and the fair market value is $5,000, you get a $5,000 deduction. Okay. And then finally, the last question, Brendan talked about due on sale clause. Yes, a lot of people talk about the due on sale clause when you transfer a property from your name into an LLC name. As long as you're making the payments, 99% of the time, the lender will not bother you. So the due on sale clause is just a legal thing. Chances of it happening are slim. There's other reasons why putting the property in the LLC may or may not work. Okay. All right, thank you, thank you, thank you. For those of you who will be attending my party, I look forward to seeing you on Zoom or in person. For those who are able to come out in person, please, if you have any questions, please reach out. If you have not yet sent in your tax documents, for those of you that are in the wealth building program or you're not, but you want to pay for the service, please send us your tax documents. We stop accepting tax documents December 8th. And then we will work all the way till December 22nd to get all of the year-end tax analysis done. Okay, thank you guys. This has been an awesome